The reason that some retirees don't want to take required minimum distributions is because they don't want to increase their taxable income. Required minimum distributions are taxed at your regular tax rate and can push you into a higher tax bracket. But if you don't take your distributions, you will have to pay a 25% penalty. The reason that the penalty is so high is because the government is basically trying to prevent you from using a retirement account to avoid taxes. If you're retired and over the age of 73, you have to withdraw a minimum amount from your employer-sponsored retirement plan, traditional IRA, SEP, or simple IRA. You have to start withdrawing from your retirement accounts by April 1st, following the year that you reach age 73. You can take all of your funds out at one time or receive periodic payments. Every year, you have to withdraw your distribution by December 31st. You may withdraw your funds periodically throughout the year or wait until year end so that you can maximize any interest on your account. You cannot roll over your distributions. You have to withdraw them. If you're still participating in a workplace plan like a 401k, then you don't have to take a required minimum distribution from that specific plan until you retire unless you are a 5% owner of the business sponsoring the plan. The distribution that you must take for the year is calculated by dividing the prior year end market value of your retirement account by your life expectancy. The good news is the custodian of your retirement account will usually calculate the required minimum distribution for you. The bad news is if they calculate it wrong, you are still held responsible for the calculation. I have included a link to the IRS website in the description box below so you can calculate your required minimum distribution yourself. You always want to double check the amount since you will be held responsible if the calculation is wrong. You have to calculate the required minimum distribution separately for each IRA that you have, but you can withdraw the total distribution from either one, a portion of each, or only some of your IRAs. You will also do the same thing with your 403B plans. You will calculate your required distribution for each plan separately. Then you can add all of these amounts together and take the total amount from just one of your 403B plans, or you can split the amount however you want and take the amount from any of your 403B accounts. If you have funds in a 403B plan, required distributions for contributions made before 1987 don't have to start until you reach the age of 75. You will have to use a plan statement that shows your balance on December 31st, 1986 as documentation to prove the exemption. The unfortunate thing is that you will have to start taking distributions after the age of 73 for any earnings made on the pre-1987 contributions. You will also have to start taking distributions by April 1st after you reach the age of 73 for any contributions made to your 403B after December 31st, 1986. When it comes to other plans such as 401ks and 457Bs, you will calculate your required minimum distributions for these plans separately, and the distributions must be taken separately from each of these accounts. So if you have 401ks with several old employers, you will have to withdraw the required minimum distribution from each individual plan. You can't pick and choose. Contributions made to Roth IRAs have already been taxed, so you don't have to take required distributions from your Roth IRA accounts. When taking required minimum distributions from your non-Roth retirement accounts, you will have to pay income taxes on those distributions. You'll receive a Form 1099-R to report on your federal tax return. The federal taxes that you may owe on the distributions may be quite high. Distributions will normally automatically have a 10% tax withheld unless you file Form W-4P to opt out of withholding. If your required distributions are sizable, a 10% withholding may not be enough. You may need to pay estimated taxes during the year or adjust your withholding so that you don't get a penalty for underpayment of taxes. One way that you can avoid taking a required distribution directly is by giving to charity. If you normally give to charity, this may be a good option. If you give your distribution to a qualified charity, you can satisfy your required minimum distribution for the year by transferring up to $100,000 from an IRA directly to the qualified charity. You won't be able to take a deduction on your federal tax return for the contribution, but the amount that you transfer to the charity won't be included in your taxable income. If you're interested in giving all or a part of your required distribution to a charity, please watch the video that has been posted at the end of this video. That video goes into what you need to do to make a qualified charitable distribution. So again, if you don't take your required distribution, the 25% penalty that I mentioned earlier will be applied to every dollar not withdrawn. Now, if you forget to take your distribution, but you fix the mistake within 2 years, the penalty will be 10% instead. If you don't take your required distribution, you will have to file Form 5329 with your federal tax return for the year in which you did not take your distribution. The penalty may be waived if you can prove that you made a reasonable mistake and that you have taken or you are taking reasonable steps to fix the shortfall. So if you believe that you made a reasonable mistake or had an unusual situation, you will write a letter of explanation requesting a waiver of the penalty. While there are no guarantees, here are a few explanations that the IRS has accepted in the past. Mental illness, details of a bad health situation, you are new to taking distributions and didn't understand the requirements, or you relied on advice from a financial advisor or the custodian over your retirement account or a CPA. You should list any and all explanations that apply to your situation. You will attach the letter to your federal tax return Form 1040 along with the Form 5329. You will also attach any documentation proving that you have fixed the problem. The best documentation would be a statement showing your late distribution along with a copy of your check matching the distribution that you should have taken by December 31st, but you took after you discovered your mistake. If you decide to request the waiver, don't pay the penalty on the amount that you plan to withdraw just yet. The IRS will contact you to let you know if your waiver request was denied and if you will have to pay the penalty. Let's take a look at an example of how you would fill in Form 5329. For example, if you had a minimum required distribution for the year of $15,000 and you only took $5,000, you would put $15,000 in box 52. In box 52, you would also include the amount that you should have taken but did not take. You would put $5,000 in box 53. If you plan to withdraw or have already withdrawn the entire $10,000 shortfall, you would put that amount in parentheses on the dotted line for box 54. Only write the shortfall distribution amount that you have already taken or plan to take soon. Then on the dotted line next to box 54, write the letters RC. Now take box 52 and subtract box 53 and also subtract the amount that you put on the dotted line for line 54. You will enter your result in the box on line 54. So in this case, you will put 0 in box 54. If you change the example and say that you are only going to cover $7,000 of the shortfall, you would include $3,000 in box 54 and you would calculate your penalty and put the penalty amount inside box 55. Now, we only went over required minimum distributions for retirees today. If you inherited a retirement account, the distribution rules are different. Please watch the video that popped up in the upper right of your screen to get a better idea of how you should handle the distributions from an inherited retirement account. Although I do thank you for spending time with me, what we just covered was not official tax advice or legal advice. Please consult with your tax advisor for personalized planning. In the meantime, if you're thinking about making a qualified charitable distribution, please watch the video on your screen right now. It will tell you a little bit more about how to do it. Take care of yourself. Bye.